Financial Wellness webinar series, focusing on ways to maximize a 401k, highlighting the benefits of tax-deferred growth, and discussing loan, rollover, and distribution options. We certainly appreciate all of you taking the time to join us today. A few items to go over before we get started. First, please note that in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. At the end of the webinar, we will take some time to go through these. And now I'd like to introduce our guest speaker of Pensionmark, Deanna Bamford. Deanna has over 20 years of experience as a relationship manager. Having graduated from the University of California, Santa Barbara with a degree in communications, Deanna is also fluent in Spanish. Deanna is the relationship manager for Pensionmark's Northern California clientele and provides bilingual enrollment support to many of Pensionmark's clients. Thank you for leading us through this webinar today, Deanna, and now I'll turn it over to you.
Thank you, Tori, and welcome again. Good afternoon, and I appreciate you taking the time to learn how to work smarter, not harder, and find out more how you can make your retirement plan work for you. I'm trying to switch us here to our next slide. Technical difficulty, sorry about that. Here we go. Let's start again here. Thank you again for joining, and in today's seminar I just appreciate you attending, and I believe you're already taking the first step into planning for your financial security, and we truly believe that you're utilizing your company retirement plan and making it work for you is going to be a huge part of achieving your goals in retirement. We know that it's a pretty safe bet that retirement in the future is going to cost more, probably significantly more than it does today. All of our costs are going up, especially healthcare costs, housing, utilities. And in addition, with people living longer, healthier lives, retirement planning is becoming more and more important, and the sooner we can take advantage and start planning, the better. Fortunately, though, we do have more choices than our previous generations. Now, just the fact that you're on this webinar, you're being offered a retirement plan at your current employer. So that is a great plus. You're being offered incredible investment choices. You have some high contribution limits, and you have the convenience of entering the plan and making changes and such. But with those choices, of course, comes the responsibility of having to make the right choice. That's what we're going to talk about today. So on our agenda today in this webinar, we hope to cover why this retirement plan is necessary. I think if you don't already feel this way, by the end here, you're going to know that there's absolutely a need to save in your plan for your retirement. Then what we really want to talk about is how much you're going to need to enjoy that comfortable retirement. What is it going to take? And we've got some tips and suggestions on how you can find those numbers. And then also we will take into account your time horizon. That is one factor that we need to take a look at. Also, your desired lifestyle, what you want your retirement to look like, your risk tolerance, your investment portfolio, and how you can utilize your retirement savings plan to match up with all those goals. So why is this retirement savings plan so important? And bottom line, Americans do not adequately prepare for retirement. Just 58% of today's workers are saving for their retirement, and of those, only about 42% have done the calculation to figure out what they're going to need. And again, I'm hoping during this webinar that we'll show you the tools and that you'll take the time, if you haven't already, to do that calculation. That's going to be the biggest service you can do for yourself to get you on the path towards achieving that goal. And regardless of your age, one of your top financial priorities should be saving for retirement. And today experts are recommending that you save at least 10% of your income or more to achieve that goal. Retirement is not what it used to be. Probably does not look like what our parents' and grandparents' retirement looked like. Just 30, 20 years ago, people didn't job hop the way they do today. Employers offered larger pension-type plans, and medical benefits were much lower cost to the employers. So, and also before, Medicare and Social Security benefits were a much larger part of total retirement income and much more secure. Perhaps it was because of shorter life expectancies that health care costs weren't such a concern to prior retirees as they are today. Today is a large part of what we need to prepare for. It's a huge concern and something that we will take into account. So let's compare that to today's retirees. Today, people do tend to change jobs every few years, whether it's because of corporate downsizing or career advancement, what have you. What that has created is less security or less guaranteed type pension plans. You just don't see that environment like it used to be. Also, along with that, today's health care and Medicare and Social Security, that's all a bigger question, whether it's going to be there, how much is it going to do for us in retirement. Health care and long-term care costs have skyrocketed. We all know this, but this is a scary statistic here. The cost of a private room in a nursing home now exceeds $90,500 a year. It's just frightening what the costs are going up to be. So again, as I mentioned, that's a big consideration. Retirement lifestyles are also changing. People are living very diverse retirement lives, whether you're taking care of grandchildren or continuing to work part-time very often. That's all things to take into consideration. And finally, as I mentioned, longevity. Life expectancy has gone up. Now we're expected, a 65-year-old now lives an average of an additional 18.8 or almost 20 years in retirement. So after they retire, so that's a long time to prepare for. And that's what we're going to help you do. So the first question that always comes up is, what are you going to need? And again, we mentioned only about 42% of Americans have done this calculation. Experts have estimated that we will need between 60 and 80% of your final year's salary each year during retirement to maintain your standard of living, which can be a daunting figure. And also, Social Security benefits, as we know, have been reduced and pushed out, meaning we have to wait longer to receive them. So let's take a look how you do some of those calculations. Let me go back here. So as you are considering what number is right for you, your replacement value, some tools that you can use are going to be on your ACECRT.com website, as well as your Great West website. There are some excellent tools, calculators, if you spend a few minutes of your time, that can help you determine. Most of the defaults is going to be 80% of your income, depending, again, what you want your lifestyle to look like. If you're really hoping to travel and be more active, you might want to use 100% replacement value. If you plan on perhaps being a little bit more scaling down or continuing to work part-time, then you can use a lower amount. And we cannot forget your time horizon. That's always a factor in how inflation affects that. So when considering how much you're going to need, we cannot underestimate the impact of inflation over time. So although in recent years inflation has been at historical lows, 2 or 3%, we know that it spikes and drops over time. So we're using a 4% inflation rate in this example to show you the effect over time. So $1,000, what it would be worth, what is good, $1,000 worth of goods today. In 10 years, you could only buy $676 worth of goods, and in 20 years, you're down to $450, and in 30, and you can see in 40 years how much your money has eroded just from inflation. So again, when you're calculating your goal, your estimated goal, I would suggest that you use one of the tools that you use the Pensionmark Wellness Center to call us and let us help you determine what you're going to need to save for retirement. As far as trying to determine how much of that 80% is going to come from Social Security benefits, here's an average, just to give you an idea, and some of you maybe have done this calculation before, but the average receiver of Social Security today is going to receive approximately $15,132 per year from Social Security wages, which again, if you try to estimate what your final year's earnings or what you hope your final year's earnings are going to be worth and take 80% of that, you'll start to realize what a small percentage that Social Security portion is going to cover. Some of you may also have the benefit or the good fortune to have worked for a company or work for a company that provides a pension benefit. If that is the case, I would suggest you take the time to contact your employee benefits administrator of that plan, and they will be able to give you an estimate of what you can expect to receive. And again, that's becoming so much less common, so it's almost a non-issue. When you do a calculation, they will assume Social Security benefits, based on today's tables. If you are interested on more specifics and want to know, you can go to the website ssa.gov and complete an online retirement benefits estimator to know what your true benefits are going to be. And again, this is just going to help and determine what you need to be saving personally from your own account to achieve your goals. So at this point, if you're feeling a little overwhelmed, you're not alone. It seems like a lot that you're going to need to accumulate for many years in retirement, but this is where we really want to emphasize the importance of taking full advantage of your retirement savings plan. It can play a huge role in helping you pursue this goal. Today, millions of Americans are using their retirement plans to help control their futures. We've got over 60 million active workers participating in plans just like you, with over $7 trillion in these type of plans. So again, this is probably going to be the largest piece of your retirement income is going to come from these plans. So let's talk about how that works. And again, this might be a refresher for some of you, a review, if you will, but it's so important to understand since you're being offered this plan and we're trying to offer you any communication we can to help you maximize it. Let's determine how these plans work, what some of your limits are, and what some of the choices you have under the plan. Again, you have the choice, which is nice, and also can be daunting because the responsibility is on you to decide how much you want to deduct from each paycheck. The IRS and possibly your employer-sponsored plan may put some limits on it. There is a dollar cap that's adjusted every year. For this year, 2014, the maximum any employee under the age of 50 can contribute pre-tax into a plan is $17,500, and that's assuming your employer allows you to contribute up to that maximum. And again, as I mentioned, that's for someone under 50. Over 50 years of age, you have an additional catch-up provision of $5,500 that you can take advantage of. So just familiarize yourselves with your maximums. Even if you're not able to get there yet, know what the potential is and make that a goal to take advantage of every cent you can in that. And then also, you might quite possibly have a choice of either a traditional plan, which would be your 401k, your 403b type plan, or a Roth style plan, which they do differ. So, and I know in every one of your cases here on the phone, you are offered the traditional plan, a pre-tax option of deferring your money out of every paycheck, and it grows tax deferred. And yes, when you go to withdraw it at retirement, you will pay normal income taxes on it, but I'm going to show you here in a moment how that tax deferred growth, that pre-tax money is such a huge value, such a benefit to you long term. The other type of plan is the Roth style plan that's been introduced over the last few years, and you may or may not have that as an option in your plan. That in those plans, your contributions are after tax, but you're able to withdraw your money tax-free. Again, with certain limitations. It's still a retirement plan, and you're not able to take it at any time, but a little different way of looking at it. So a quick example for a traditional plan, if you earn $500 every paycheck and you wanted to contribute 5%, that would total $25 each paycheck. So your new taxable income is no longer $500. It's $500 minus $25, which is $475. So that's where you get your tax savings on every paycheck. And so let's take a look at, over time, how that can grow. So here we show the power of compounding pre-tax money. So let's compare the results of two different $100 monthly investments, earning an average of 8%, compounded monthly over 30 years. So we're using the same rate of return, the same savings rate of $100 a month, and the same time frame, 30 years. But the difference here is if you put the $100 in that first column and it's being taxed, okay, as opposed to putting it into your retirement plan where it's tax deferred. So you see the difference. After 30 years, your tax account is going to be worth just over $100,000 compared to your pre-tax tax deferred account with a balance of $150,000. So that is over $50,000 difference just putting those tax savings to work. And again, you will pay taxes as you go to withdraw that $150,000, but we are assuming here that when you go to withdraw it during your retirement years, you should be in a lower tax bracket, and it will benefit you long term. Another big advantage of your company-sponsored retirement plan is the possibility of a company match. Some have them and some don't. Something you need to and want to be aware of. What, if you have a match, what is it? To what percentage? And then the vesting on that match as well. So let me just explain quickly. If you do have an employer matching contribution, I would consider it bonus money, free money. Absolutely, you want to take advantage of that without question. But again, if you are not being offered a match currently, there is still an absolute need to save, and you still have the tax deferred benefit as well, and you still have the flexibility of choice and transition if you leave the company, which we'll get to in just a moment as well, the rollovers. So if you have a match, be sure you understand your formula, you know it, be sure you're maximizing it. And then also, if you see the word vesting or you're wondering what does that mean, when you see vesting, it only applies to any company match money. And what that means is if you were to leave your employer, how much of the match is due to you. And it's going to be based on a schedule according to your years of service. And so it starts from your date of hire, and however many years you've completed is what you get to take with you on the match. Please remember that your contributions, the contributions you make, plus the earnings on your contributions are always 100% vested. Those are yours to keep. So keep that in mind. So now that you have an idea, anyway, you might have to do this calculation later, but you have an idea of what it's going to take to retire, how much income replacement you may need, and hopefully you have a good understanding of how your plan works and what your options are. Our next step here is to review the investments. This seems to be sometimes a difficult task, and I know we're all pressed for time and busy, and it seems like, oh, so many choices. I do know in your plan, ACEC has done just, they put in a ton of resources and time and energy and consultants in managing your investment menu choices. So you have that huge benefit that when the choice comes down to you, all the investments offered on that platform have been, are being looked at and reviewed and are just excellent choices. So what your responsibility is, as it being your money, of course, is to just have a general understanding of what those investments involve. What are they investing in? What are the asset classes? And what are my risks in each one of them? Once you understand that, then you can determine what's the right mix for you and use, again, some of the tools and resources we have. You're not alone in this. We're here to help you. So first, let's talk about the asset classes. There are basically, you can break down, there are 3 basic asset classes. And you may say, well, what do you mean I've got 20 plus investments on my menu? Yes, you most likely do, but each one of those investments are probably investing in one of these three basic asset classes. And we've got stocks, bonds, and money market instruments. And we're going to take a look at them and compare their historical returns, because as we all know, we can't predict the future. Wish we could. It'd be much easier to make those investment decisions, but we cannot. So we can take a look at history over long periods of time and make educated decisions going forward. We can't just take a look at returns, because then it would be obvious. Well, that's stocks have had the highest historical returns, bonds in the middle, money market at the bottom. But again, with that comes risk. So the stocks have, again, had more risk or volatility. Bonds also have their share of risk. There's no guarantee there. And money market instruments may have the lowest risk, but historically the lowest return potential as well, which we had talked about that inflation rate, and that's where the money market risk comes in. So let's take a look at it, a closer look at an example here on how those different asset classes have performed over time. So let's start with stocks. For 30 years ended December 31st, 2012, stocks have obviously outperformed every other type of investment. They've returned an annualized average of 10.81%. You see the red dot to the far right on this slide. So they've had the highest return over the last 30 years, again ending December 31st, 2012. But with that, you see a measure of risk. There has been more risk associated with that, and what that means to you is there are days, months, there have been years in the past where we can see negative returns or losses in that stock portfolio. But sticking with it over the long run is proved to pay off. Next, if you want to take a look at the bonds, I'm going to skip that middle one for just a moment. So let's take a look at bonds. And they have produced an annualized return of about 8.1% over the same 30-year period. So yes, almost 3 percentage points less, but they've also had lower risk, okay, or standard deviation. That's that axis across the bottom there. So maybe you're able to sleep a little better at night knowing that your money is not going up and down at such a rate, but your long-term returns aren't quite where they could be. And then, of course, cash down at the bottom left corner, obviously with the lowest historical return, but also with very little risk. Now, I wish, as of recent, if you've been in any type of cash investment over the last couple years, it's significantly lower than that. You're lucky to even be pushing 1%, and that's where we really get into the issue of inflation, and is it worth it to stay away from risk and not get the returns you need to keep the purchasing power of your money up. So what I want to focus on here is that mixed portfolio, or the asset allocation portfolio. And again, this is just an example. Historical returns, there's no particular fund in your plan that has returned this exact amount. But if you take a look at that mix of 60% stocks, 30% bonds, and 10% cash, you see an average rate of return of 9.66. That is pretty darn close to the stocks, but look at where it is on the axis on the risk scale. It is significantly less than the stocks, than 100% stock portfolio. So yes, you give up about 1% of return, but maybe you gain a little better night's sleep a couple nights during those very volatile market times. So that's what we're talking about when we talk about asset allocation, and you hear that term thrown out there all the time. And so I'd really, if nothing else, I just encourage you, you have an excellent menu of choices, as I had mentioned, where you need to concentrate your time and your energy and your efforts in planning for your retirement. It's going to be on your asset allocation mix, because whether it's 100% stock portfolio, every stock is different, and you have many different types of stock funds, and of course they all include risk. Bonds, likewise, there is different types of bonds. There is government type bonds, which do have a type of guarantee to them. They just have the interest rate risk. And then there's other types of bonds, more high yield bonds, that take on more risk, more what we call default risk, the chance that the corporation that's that you're holding the bond with is going to be there to make good on your bond. So there are different types of risk within each asset class. And again, to help you mitigate that, We have some great risk tolerance type questionnaires. Let me move forward here to help you determine, because what's going to help you determine, well, how much should I have in each one of those categories? It's going to be your time horizon. That's a big factor. And also just your personal feelings about risk, your own personal risk tolerance. And so those two factors, again, we have on the Great West website, or we have available to you just a very simple, quick risk tolerance questionnaire. If you're interested, if you've never done that exercise in the past, it could be enlightening to see how your assets should be allocated amongst the different asset classes. And then this is something that you probably want to review every few years, especially as you're approaching retirement. It's something to take a look at. And again, we have resources. We want to help you achieve your goals. And within your plan, you have some funds, I'm sure, that kind of do this for you. So if you have a target date series, you know, those funds with those dates on them, you can simply pick based on your age. Or maybe you have some asset allocation options available to you as well. So that's important to determine, and we want to help you get there. Then now let's kind of talk about, let's move to the distribution side of it. So once you've done the work, you're saving, you're being diligent, you're checking those investments and getting the help you need, then how and when should you take it out, or can you take it out, and how does that affect your balance and your savings? Very important to know, to be reminded that there is kind of a magic age when it comes to these plans, which is 59.5 years of age. So you can start withdrawing from your retirement savings plan penalty-free when you reach 59.5 years of age. Now, whether you can do that while you're still employed is determined by your plan document. In most cases, you can. And certainly, when you separate from service, if you are age 59.5 or above, you are able to take a penalty-free withdrawal. You will pay taxes, right, on any amount that you withdraw, but just normal income taxes if you've reached that age. Now, if you try to take a distribution prior to age 59.5, there is a mandatory 20% withholding, which will automatically be withheld and sent directly to the federal government to cover your income tax obligation, which you have not paid on. And then in addition, you will most likely have to pay a 10% early withdrawal penalty, again, if you're under age 59.5, and that's going to be assessed at year end when you get your 1099. You're going to owe an additional 10% on your total balance, not on the 80% you received. And depending what state you reside in, there may be an additional state penalty tax. I know because I am in California, that in California we have an additional 2.5% tax. And again, some states do not. But just be aware that early distributions can really hurt you. So, and also I would like to point out, on the other side, people are working longer. So there are required minimum distributions, sometimes referred to as RMDs, where you need to start taking a minimum distribution at age 70.5. Okay? Now, one of the benefits to understand, if you are still employed and a participant in the retirement plan, you do not need to take those minimum distributions. But once you separate from service, or any money you have outside of your employer's plan, such as IRAs or prior employer's plans, will be subject to that minimum distribution rule. So again, I just point this out. If that's something you need more information on, please contact us. We'd love to, talk to you and make sure you understand that as well. So that's the other side of the distributions. And then most people, what you wonder too is, okay, well, those are general rules. Now, what if I leave my employer for whatever reason before I'm age 59.5, or before I'm ready to start receiving income and paying taxes on it? What are my options? And rollovers is by far, without a doubt, your best option. And over the years, fortunately, this is one of the things that they've made easier and more flexible in these plans, changes for the better. So you're now able to roll over from most qualified retirement plans to other qualified retirement plans. So that's nice. You can go 401k to IRA to 403b to 457. So all these different terms. Before, it was difficult to go from one to another directly, but now you can. So let's talk about the difference of a direct versus an indirect rollover. These days, really, especially you're with Great West, the direct rollover is usually what you're going to do and what I hope you would take advantage of. And what that means is the financial institution or corporation where your money was is going to either do an electronic wire transfer or make a check payable to the new institution or corporation where you want your money to go to. That type of direct rollover shelters you from any tax consequences or penalties. So that's the way to do it. And again, as we had mentioned, just today we tend to, possibly job hop every few years, and if that's the case, we want to help you take that money from one job to the next, keep it with you, keep track of it, and do those direct rollovers. Now the indirect rollover, let me explain, is different in that this is where the check has been made payable to you. So you leave a corporate sponsored plan or an IRA, and perhaps you didn't make an election or didn't know where you want it to go to, so they make the check payable to you, which means they've already withheld that 20% mandatory tax withholding. If that is the case, you do have 60 days to reinvest that money in another qualified plan to avoid penalties. But you must make up the 20% that was withheld out of your own pocket. You need to make it whole before you can keep it exempt from taxes and penalties. So just keep that in mind as well. And again, in most cases, the direct rollover is your best and easiest option. So I hope today I have showed you the importance of saving for retirement and how your company-sponsored retirement plan can help you meet these financial goals. So now it's kind of up to you. I've got to put it in your hands, and hopefully you take the next steps, which would mean take a look at what your plan offers. Make sure you're maximizing your benefits, your match, your maximum contribution limits if you can get there. Do the projections. If you haven't done them yet, it doesn't take very long. Find out what you need, and if you're on track, and sometimes it's just small moves that can help you get to where you need to be. And consider here how the earlier you start, what a great ally time can be if it's on your side. So in this example, let's take a look at investor A, who starts investing at age 25 and invests for just 10 years. For whatever reason, investor A stops investing at age 35. So over 10 years, they've contributed $100 a month for 10 years, which is a total of $12,000 investment, and just let it ride, meaning didn't add another cent. It continued to earn. We're assuming an 8% average rate of return again. And at age 65, investor A has $185,000 available to them. Compare that now to investor B, who invested for 30 full years, so 3 times longer than investor A, also contributed $100 every month, also earned 8%, we're assuming again in this hypothetical example. But unfortunately, investor B waited till age 35 to start participating and did contribute for a full 30 years, age 35 to 65. Total investment out of investor B's pocket was $36,000, and at the end of those 30 years ended up with a balance of $150,000. So quite a bit less than investor A, and they invested more money for a longer period of time. The problem was they waited. So time can be your friend. The earlier, it's never too soon to start. The sooner the better. But again, I never like to discourage anybody that didn't have the benefit of starting at age 25. It's never too late. It's just never too late. So just means you might have to, it's going to take a little bit more. You're going to have to save a little bit more, maybe be a little bit more creative on the investing, use our resources, let us help you. That is our goal, to get you to where you need to be for retirement. So with that said, we've got our standard disclosures, ways to stay connected. And then I think I'd like to turn it over to you, Tori, to see if we have any questions in the audience that I can address.
Great. Thank you so much, Deanna. We appreciate you sharing your time and your knowledge with everyone here today. And like Deanna mentioned, we'll go ahead and start addressing some of the questions that have been filtering in. And please remember that if you have any questions while we're going through these, that you can submit them using the Q&A tool in the webinar menu. And once again, be sure to reach out to your ACECRT Financial Wellness Help Center if you have any further questions or need any personalized help. And that phone number is 844-ACECRT-8, or you can email at financialwellness@acecrt.com. I'm just going to go ahead and click over to our questions and see if we have any that have come in. So our first question for Deanna. So can any additional be added past your max into a Roth? If Roth is post-tax, shouldn't we be able to put money in addition to our traditional 401k?
Good question. I like your way of thinking, whoever asked that. Actually, the limit, that overall $17,500 max, applies to both. It's a combination of the two, unfortunately. That makes sense. You know, why couldn't we put in more? But unfortunately, I think the government has figured out that if we're able to put in as much as we want after tax, they're not going to collect anything on the back end. So the total overall limit is the set max, and that includes both. So you are able to split it between the between the Roth and the traditional contributions in any manner that you wish if you're being offered both. But no, you cannot go beyond the limits by putting more into one. Great question.
Great, thank you, Deanna. Another question we have for you is, for those of us that are not as knowledgeable in 401k plans and Roth IRA, what are some additional resources that we can find to help us?
Ooh, nice question. I have to say, from what I've seen from your ACEC Financial Wellness Center and support in your website that I've looked at, you have some excellent tools. I believe you have a link to go directly to our Pensionmark site. If not, you are welcome to go to the pensionmark.com directly, and there we have pre-recorded webinars, we have newsletters, we have links to videos, which are most helpful if you prefer or enjoy watching rather than reading. There is just a wealth of information out there. Also on your Great West website, there is some excellent information on how the plans work. So I hope with that, and if you'd like to just call our Financial Wellness Help Center and get some specific, if you have some specific areas that you'd like some more information on, we have a catalog of pretty much every topic you can think of, and would love to share that information with you. Thank you for that question.
Wonderful. Thank you, Deanna, and thank you to all of our attendees for your participation today. This will conclude our webinar session. I hope everyone has a great day, and we're looking forward to our next webinar series with you. Take care.